What do you think of when you hear the name Chamath Palihapitiya? Entrepreneur, podcast host, rich dude, SPAC king, maybe something more critical? Well, with Chamath recently announcing his next SPAC, American Exceptionalism Acquisition Corp, the reactions have been very critical, pointing to his track record of SPACs and past comments. You have people calling the top, calling it a scam, predicting its failure, and everything in between. And I get it, I myself have lost money investing in his past SPACs. If you watched my last video about Opendoor's recent run, you'll know that I bought shares of Chamath's second SPAC, Opendoor, at over $20 per share years ago, back when the ticker was still IPOB. Not only that, I invested in Clover Health at over $14, Virgin Galactic, Desktop Metal, Metromile, SoFi, all of which are companies either Chamath directly SPAC'd or companies he was involved with during that COVID-era SPAC wave. So I had skin in the game and I paid the price. But does that mean that this SPAC is doomed to underperform too? Is all that backlash warranted? And is there anything different about SPACing this time around compared to last time? In this video, we'll try to answer these questions and analyze things as objectively as possible. And at the end, I'll share whether I'll be investing in this SPAC. To start, here's a quick summary of what a SPAC is. SPAC stands for Special Purpose Acquisition Company. It's basically a side door method of taking a company public. First, a sponsor, usually a private equity firm, hedge fund, and/or high-profile venture capitalist, forms a blank check shell company called a SPAC and takes it public. This SPAC then sells shares to raise money and holds that money while looking for a private company that wants to merge with it. By merging, the private company gets access to the money raised and effectively takes the place of the SPAC and becomes public. And why SPAC? For companies, this can be a shortcut to going public with fewer restrictions. There's also more certainty on the valuation because they get to negotiate the price directly with a SPAC sponsor ahead of time rather than doing this arduous roadshow and book building process that they normally have to do in a traditional IPO. As for sponsors, their role is to organize the whole thing, foot the upfront administrative costs, and market the fundraise. Their incentive is to promote, which for most SPACs means getting 20% of the company's shares for practically free, as long as they can close the deal. That's where some of the controversy comes in. Sponsors have a big financial incentives to spam deals and just get companies public because they can get paid immediately, walk away, and then do it all over again with a separate company. And because going public via SPAC is technically an M&A transaction and not an IPO, SPACs don't have to adhere to the same disclosure policies of IPOs. IPOs have to stick to historical financials and can't publish forward-looking projections about the revenue and growth, but companies merging with SPACs can. This is where you might have companies that are underperforming or losing money, being hyped up with rosy future projections and lofty narratives that the sponsors push. But time and time again, we've seen that once some of these companies go public and start reporting results, company insiders and SPAC sponsors cash out, sentiment sours, and their share prices tank. So with that in mind, let's go through the S1 filing for AEXA and see what we learn. American Exceptionalism Acquisition Corp is raising $250 million, selling 25 million shares at $10 each. The SPAC is chaired by Chamath himself, with Stephen Thrugh as CEO. Stephen has been CFO at Chamath's fund, Social Capital, since 2017 and is pretty involved with all their ventures, including Grok and 8090. Thematically, AEXA, as you can tell by the name, American Exceptionalism, is looking for companies that help keep America competitive against the current backdrop of AI advancement and global conflict. To quote from the S1, we intend to find companies that operate in sectors that we believe will be instrumental in maintaining U.S. global leadership for the next century. Here's a related framework that Chamath has articulated on the All In podcast before.
In order to be a superpower, I think you need to have three things, but they work in a hierarchy. The first is that you need to have technical supremacy. And then from that technological supremacy, you need to establish and project economic supremacy and military supremacy.
Each of Chamath's past couple series of SPACs had their own themes as well. IPO A through F was the Social Capital Head of Sophia series, which focused on mission-driven tech companies. Pretty broad statement, but under that umbrella came Virgin Galactic, Opendoor, Clover Health, and SoFi. Each of them was trying to transform a different industry: space, real estate, healthcare, and finance. Compared to their original SPAC prices, Virgin is down almost 99%. Opendoor and Clover are down about 70%, even after Opendoor's recent run-up. SoFi is the only one doing well, up 150%. Then you have DNA A through D, the Social Capital Suvretta series, which focused on biotech companies. And through that, we got Achille Interactive, a prescription digital medicine company, and ProKidney, a company doing cell therapy for chronic kidney disease. The other two didn't find a merger and ultimately liquidated. Chamath's thesis for biotech SPACs was that biotech companies struggle with going public because of their long timelines developing drugs and getting through clinical trials. There's a lot of risk riding on whether drugs get approved, so it can be hard to raise the requisite money to grow the company. So SPACs could bridge that gap by taking them public at a controlled valuation and arming them with the financing to grow. But in retrospect, biotech SPACs have performed really poorly. Achille debuted at $10 a share and was ultimately acquired a couple of years later at 43 cents a share, down 95%. ProKidney, as of the time of this S1 filing, was sitting at $2.36 a share, down 76%. And regarding Achille, they had this mobile game for helping kids with ADHD. I actually downloaded the app at the time to do some due diligence, and I almost made a video about it because I was appalled at how low quality the app was. Poor graphics, poor gameplay, just not made to any current mobile app best practices. I remember thinking at the time, like, why would you prescribe this shitty mobile game to a child? How is this going to help anyone? That's actually the only Chamath SPAC whose product I used that I felt was actively horrible, so I steered the heck away from that company. At least with companies like SoFi, Opendoor, and Metromile, I felt like they were legit companies with products that are respected, but maybe priced way too high at the time for it to be a good investment. I'll also note that DNA, A through D each raised $250 million, whereas IPO A through F raised between $400 to $800 million each. So if AEXA is also raising $250 million, then maybe we're looking at a company valuation closer to Achille and ProKidney. Achille debuted at a $500 million valuation and ProKidney had a $1.8 billion valuation. So my feeling is that the AEXA merger will be in the low single-digit billion valuation range, which of course rules out a lot of bigger private tech startups. Now going back to AEXA's thematic focus, the four industries they're looking at are energy, AI, DeFi, and defense. All of these are very hot right now and tie into what's trending in Silicon Valley and politics. All very fundable ideas. I'll point out that in the S1 under each industry, Chamath lists a related company that Social Capital has been involved with. This doesn't mean that these are merger candidates. SPACs aren't allowed to pre-select the company they plan to merge with, so these are more disclosures to show Social Capital's track record and any potential conflicts of interest. As far as AI goes, this is the hottest sector in tech, so AI company valuations like that of NVIDIA, OpenAI have soared, and most big tech companies are investing billions. AI startups across hardware, software, B2B, consumer, they're all raising a bunch of money and growing fast. Chamath would probably target a smaller player though, maybe an infrastructure company and probably not anything directly consumer. So as far as AI related companies in Chamath's portfolio, they list Grok, AI chips company, and Icebox Energy, a data center cooling company. With AI comes the need for energy, so that's the next category. Chamath has been a long-time vocal proponent of solar, so I think there's a high chance we see candidates in the solar capture or solar energy storage spaces. He currently has investments in Palmetto, a solar installation company, and Mitra Chem, a battery manufacturer. On the defense side, there's been a whole resurgence of defense startups over the past few years, partly due to geopolitical issues creating demand for these products, as well as changing Silicon Valley attitudes around the space, partly spurred by the Trump administration. Catherine Boyle, an investor at Andreessen Horowitz, was actually one of the first VCs in Silicon Valley to push for this. She backed Anduril early on, back when there was a stigma around investing in defense. And she also started the American Dynamism Initiative at 816Z. So, whereas 2 to 3 years ago, it would have been very unpopular to engage with defense companies, defense is now very much in vogue. And you have companies like Anduril, Shield AI, Saronic, and Epirus growing fast. I don't think any of these would be SPAC candidates though. It'll probably be a smaller company. Who knows, maybe something drone related. And with DeFi, there's a bunch of crypto tailwinds right now. You have recent legislation with the Genius and Clarity Act, Bitcoin and Ethereum hitting all-time highs, and Circle's very successful recent IPO, proving that it can be a great time for a crypto company to go public again. I don't really know anything about the space though, so I have no idea what a SPAC candidate might be. So personally, I'm least interested in a DeFi SPAC. Moving on, the last part of this SPAC I want to cover is Chamath's own thesis around why he's doing another SPAC, as well as his warnings to investors. The trend he calls out is that companies are staying private for much longer these days. In the past, once companies grew to a certain size, they had to go public for the sake of liquidity and raising more money. But nowadays, they can just get both due to increased capital floating around in private markets. Take Stripe or SpaceX, for example. Stripe is worth around $90 billion, SpaceX $400 billion. They've both been private for a long time and could easily go public, but they don't have to. They're able to give employees liquidity by just selling to new investors, and the administrative hoops of being a public company maybe just isn't worth it for them right now. Chamath also says that the traditional IPO process itself is inefficient, calling it a management distraction with suboptimal price discovery, and that price volatility is always there after going public. So he offers SPACs as a more efficient way of going public that alleviates these issues. I think the incentives he brings up are fair, but I don't know that SPACs are necessarily the silver bullet he makes them out to be. I would argue that direct listings, for example, are a much better path. At least certainly more retail-friendly and employee-friendly. Companies like Spotify, Slack, Coinbase, and Amplitude all went public via direct listings. You're not diluting existing shareholders by issuing new shares. You're not giving handouts to banks and their wealthy clients. And employees can sell on day one with no lockup. To Chamath's credit though, the sponsor terms of this SPAC are much more shareholder friendly compared to his last SPACs. There are no warrants, so investors are just buying $10 shares without the dilution that can come from warrants. Also, SPAC sponsors usually get a 20% promote regardless of stock price, but this time around, Chamath only gets his shares if the share price hits $15. So, assuming an investor buys at $10 per share, if they don't hit at least a 50% return, then Chamath gets nothing. That's compensated on the back end though, where his promote is set at 30% instead of 20%. So by being performance and risk aligned, he's asking for a bigger return. I think that's somewhat fair. The last thing to call out is how he words his risk disclosure. To quote, "This investment is most suitable for institutional investors and retail investors should approach with caution, if at all. We believe that retail investors should only participate if A, this investment is a small part of an otherwise diversified portfolio, B, this investment is a quantum of capital that they can afford to completely lose, and C, if they do lose their entire capital, they will embody the adage from President Trump that there can be no crying in the casino." The "no crying in the casino" bit has been a common phrase he's been using on X and elsewhere. He's basically saying that you should be aware of the risks when you gamble on stocks, and if you lose money, that's on you. Don't complain to me about it. This is where I understand both sides. There are a lot of retail investors who follow Chamath, probably listened to him on the All In podcast, read his one-pager memos on each SPAC, decided to invest, and then proceeded to lose a lot of money. And if that happens to you, you probably feel cheated and misled, especially if after getting burned, he tells you that it's your fault and to stop complaining. Again, I was one of these people who lost money, and I get it. At the same time, though, I agree with him that the onus ultimately falls on the individual investor to take responsibility for their decisions. I don't blame Chamath for me losing money on these investments. I blame my own inexperience and inability to analyze his pitches objectively at the time. Last time around, I got lost in the narrative hype in the bull market where everything seemed like it was going up. And this is not just a Chamath thing. Deal makers across every product and industry are going to sell their investments as hard as possible and be incredibly biased. That's just how it is. It's not just SPACs that crashed from a few years ago, too. Tons of asset classes, including real estate startups, public companies, private companies, they all had their values crash from the previous bull market. Lots of investors got wiped out. Chamath also gets memed for his man in the arena comments. And while sure, it can be cringe, I don't think he's wrong. He's the face of these SPACs, so during good times, he gets credit, and during bad times, he takes the criticism. If you're watching this as a Chamath hater because of his past SPACs, then let me ask you this. Do you know who Ian Osborne is? He runs the investment firm Hedosophia, which is where IPO A through F social capital, Hedosophia, got half their name from. He partnered with Chamath to execute those SPACs. Yet most people probably have never heard of him, so he doesn't get dragged as much. Or for people who watch the All In podcast, what do you think about David Friedberg? He was an early investor and board member for Metromile. He was talking about Metromile on the All In podcast years ago and got to cash out when Metromile SPAC'd, yet I don't see anyone calling him out for anything. Nor do I think they need to. Look, I don't blame Chamath, and at the same time, I don't have too much sympathy either for when he gets criticism. He talked a big game comparing himself to Warren Buffett, so he'll have to face the music. To close out this video, I've saved the least important part for last, and that's what I'm doing. This is not financial advice, and you should do your own research, but I plan on buying a small position, maybe like 2% of my portfolio. Part of my motivation is just to be invested enough to follow along. After all, I'm making this video, and I've been following Chamath for a while, so call it journalistic interest. I like that he's included a $15 share price hurdle for his founder shares, much better alignment, so I'm going to be looking to buy as close to $10 per share if that's possible. Because there's no way of knowing what company is going to be ahead of time, there's not too much due diligence you can really do. A lot of it right now just comes down to the sponsor. Do you trust Chamath's judgment or not? And at this point, with his SPAC record very publicly out there, if you invest and lose money, that's on you. And to echo his S1, I don't think retail investors should be investing, especially if they aren't okay with losing their entire investment. So my hope is that he takes a high-quality, mission-driven company public that's building for the long term. For example, I mentioned in my last video that I still think Opendoor is a great company who will rebound over time. And with Metromile, I've been a long-time customer of that product. They got acquired by Lemonade at a low price, and people lost money, but now Lemonade's doing great. So regardless of short-term price action, I just hope that over the long arc of time, these are great companies whose shares I wouldn't mind holding for a long time. So time will tell, and maybe in a couple months, I'll make an update video once there's more news. And until then, thanks for watching.